I'm going to share with you now one of the most significant investing strategy tips that I've learned from two-time U.S. investing champion Mark Minervini. And the strategy tip is this. If you want to make truly tremendous returns in the stock market, life-changing returns, then you need to be trading the small and mid caps, not the big caps, not the mega caps. I'm going to explain why in this video. It's pretty interesting. And then I'm going to show you a couple charts so you can visualize it. And I'll ask from you, if you get something out of the video, please like the video. And remember, this is just for entertainment, just for education. This is not investment advice. So here's what he said the other day on Minervini Private Access. So there's a theory called the random walk theory that stocks price in all information instantly. Stock price is random, and technical analysis is a bunch of hogwash. And with the big caps, to a large degree, that's true. There are so many eyeballs on these big cap stocks. If you think about a stock like Apple, there are hundreds, if not thousands, of analysts covering the stock, pouring through every line of the balance sheets, reading every news headlines and adjusting their recommendations and so forth. And the price of Apple, therefore, is very efficient, and the chart is much more prone to random daily and weekly moves. So, yes, the stock eventually is a weighing machine, right? And is moving up a little bit faster than the averages, maybe 1.5 or 2.0. But it's so efficiently priced that there's no price discovery to be made, so to speak. And then also, you have a dearth of new buyers. Certainly Apple can keep buying up its stock, and certainly the institutions in Apple can continue to put more money into it. But there aren't any fund managers out there who will wake up tomorrow and say, wait a minute, there's a company that makes really nice phones and watches and earbuds, and I can buy stock in it. No way, I'm going to do that. No, that everyone to a large degree, all of the big institutions that want to own Apple, own Apple. I'm going to show you the chart in just a minute, and you will see the randomness. It's definitely kind of a random walk. Now, conversely, and a big cap is defined as any stock over 10 billion. Apple is one of, if not the biggest stock in the market, at 2.2 trillion. Now, the opposite can be said about small to mid caps, especially the small caps. They are not priced efficiently. There may be just a handful of mutual funds invested in them. There may be just a handful of analysts tracking them. Some of the small caps have no institutions and no professional analysts following them. Because of that, they are priced very inefficiently, and they are prone to making huge moves in either direction. 10x in a year, 2x in a month, as the right price is suddenly discovered by investors. And you will find, on average, that patterns build much less randomly, much more deliberately, and therefore much more tradable. And more simply put, technical analysis pattern buying, whether you're buying breakouts or pullbacks or what have you, work much better with the small to mid caps. Now, there is a low range cap on this. Once you get into stocks below, say maybe $7, what Minervini calls garbage stocks, then they start to get extremely random and extremely volatile again. So you really want to get a sweet spot of the small to mid caps, which is any stock below 10 billion in price. In market cap is the share price times shares outstanding, but with a price of say $7 and up, really $10 and up is a little safer. It just weeds out some of the volatility. Now let me show you a small cap chart and then the chart of Apple, and you will see the random walk randomness of Apple, the big cap, versus the small stock I'm going to show you. Now obviously I'm cherry picking here. I purposely picked a pretty random big cap and a pretty random and a very nicely formed small cap. But I'm telling you, if you look at 500 charts of small and mid caps and 500 of the big cap charts, you will notice an overall trend in them, but you will notice that the price action in the small and mid caps is much more predictable and much more tradable. Let's take a look. So here is the 20-year chart of Apple. Notice you have the nice uptrend up and to the right, and obviously it's been doing well long term. Although to be fair, if you look at the S&P 500, Apple's really not much more impressive than the S&P 500 ever since it became a big cap. And if you look at the 1-year chart, it's pretty random. Look at the random price action. Sure, we could argue that you kind of have maybe a triple bottom here, but it fails to break out. You got another little double bottom here, but there's no handle. The price action is really wide and loose. Then you've got this frozen rope uptrend, which would be very dangerous to get into because it's so extended. And you've got a little bit of a symmetrical triangle forming over here, maybe a little bit of volatility contraction, but overall, this is not a chart that I want to trade off of. What a mess. It's very random. In contrast, here is a chart of Belfuse, BELFB. This is one of the charts from my Patreon portfolio. Every weekend I show my current portfolio and focus list. And this stock has a market cap of 350 million. It's very small. And look at the price action this year. Look how nice and tight it is. And here at the beginning of the year, we had this nice little double bottom with this big breakout, and then it went back into a nicely formed base. And here it gave you a little cheat handle you could buy off of this handle right here. And then, it gave you this little pivot. You could buy a little bit more off of this pivot. Here you had the big breakout on earnings. And here it's set up another nice little base and a little cheat. I actually bought this cheat area right here. And the price action has just been much more predictable, not to mention explosive, right? So if you don't want to actively manage stocks and do fair number of trades and so forth, then put most of your money in a big mutual fund that does one of the indexes like the SPY, for example. And then you could augment that with a few of the best big caps like Pepsi, PEP, or Apple, AAPL, etc. And then you're going to outperform the averages a little bit, right? But if you want to devote a lot of time and in exchange make supersized returns in the market, enough returns that you can retire early or become a professional trader, then the key is to mostly trade the small cap and the big caps. Sure, you probably want to have a little bit of a foundational position in the S&P 500 and maybe a long-term position in a handful, you know, I don't know about a handful, but a few of those big caps. But the majority of your money and the majority of your trading, you should be actively trading in the small caps and the big caps because of their inefficiency and the price discoveries that are made, which lead to tremendous opportunity. And that's how Mark Minervini grew his account from like 30,000 to many, many millions in a span of 6 years, was trading the small caps and the mid caps. Let me know your thoughts on this, and you're welcome to check out my Patreon portfolio. It's only $5 a month, and I will see you guys in the next video. Take care.